Anant Goenka, Vice Chairman with CEAT now joins us. Let's connect with him to understand that what is the way forward for the tire industry, how things are shaping up, and what kind of incremental changes we should expect from this sector going forward. Mr. Goenka, good morning. Thank you for joining us. Haven't met you in a while. So how are things at your end? With these numbers, I'm sure you'll be a very happy man.
No, thank you. No, it's great to see you, and certainly nice to see a bounce back in terms of performance. It's been a challenging year and a half, with raw material prices having gone up a fair amount in a very short period of time. But with that having stabilized, I think we've been able to see better margins. Growth in the last year has also been very attractive at about 20% plus levels. So certainly at a happier position right now.
Was the last financial year tough on the demand front and also on the raw material front, or it was only the raw material challenge?
Right. So it was quite a volatile year. The first half of the year was very challenged because of sharp increases on the raw material side. The second half of the year, things started to get better, and then we started to get the benefits as we consumed the lower priced raw materials, which came into Q4. So to that extent, margins largely improved quite sharply between, say, Q1, Q2, and Q4. On the demand side, I'd say demand has been mixed. We cater to three segments. The OEM segment has been very attractive all through the year. I'd say led by commercial vehicle doing very well. Passenger car segment also shrugged off the semiconductor issue to a certain extent. The two-wheeler segment on the OEM side, though, has been relatively slow for the last 2 or 3 years to a certain extent. But overall, OEM growth has been at 25-30% plus kind of growth rates. The second segment we serve is the replacement segment. I'd say their demand has been kind of at GDP kind of levels, normalized kind of growth rates that we're seeing. That also is a reflection of what happened with respect to OEM demand in the last few years' time, which has been affected because of the various rule changes that have happened because of COVID, etc. And exports towards the second half of the year started to get weaker because of recessionary trends around the world, because of currency devaluation in some of the developing world. So these had an impact on international business demand as well.
For a tire company, there are two large components. One is carbon black, a crude derivative. I'm just breaking it for our viewers. And second is rubber. And on both the front, things are looking up. So as we move into the future, and if raw material prices stay where they are we looking at an exponential jump in your margins and profitability?
So just to add, I'd say about nearly 50% of our raw material are crude derivative products, not only carbon black, but whether it's rubber chemicals, nylon tire cord, etc. So 50% is crude, about 35-40% is natural rubber. I'd say the raw material prices have kind of bottomed out at this point of time. We're not expecting any dramatic increase, but we expect it to be range bound going forward. So I'd say that margins will be hopefully a little range bound to that extent. We don't expect a dramatic increase in margins going forward. Crude, I think, at about between $80 and $85 is what we're seeing it. Natural rubber today is at about 150, 155 rupees per kg. It's gone up a little bit from about 140 lows in the month of, say, December, January that we saw. So I'd say not a major change in terms of raw material prices as well as margins for the next visible 1 to 2 quarters.
Quite interesting, Anant. In fact, we were just chatting while you were talking about your assumptions in crude. You perhaps are the best one to get in for commodity shows as well. Quite an expert at that.
No, not really. I think it's just around the areas that we focus on and that affects the tire industry.
Oh yeah, absolutely. You have to gauge it minute by minute, I'm assuming. But tell me, while you are making that assumption that commodity costs may have bottomed out and demand, I would say, is still a little bit wobbly, what do you do to your Capex then at this juncture? Do you not invest in capacity expansion for the year ahead?
Right. So we've had a very large Capex cycle over the last 3 to 4 years' time. We've invested nearly 4,000 crores. So in fact, we are quite uniquely positioned that the Capex that we have about 20% upside in terms of capacity utilization now. So as demand picks up, we may not need to invest much more in terms of capacities, whether it is on the passenger car, two-wheeler side, off-highway tires. These are areas that we have been investing and we have upside. So certainly I'd say earlier where we were doing about 1,100 crore Capex per annum, that may get normalized to say about 700 crores, 600 crores going forward. And that would be relatively smaller brownfield expansions that we will need to do on a regular basis to grow.
You touched upon the international geographies. What's the outlook with respect to exports going forward? And also you were expanding your presence when it comes to tapping the opportunity in the EV vertical. Plans around that?
Right. So I think the exports is seeing some amount of uptick now. The last 4 months has been challenged, but I think things will get better going forward. Maybe not very dramatic shift, but I think in our case, we've been investing a lot on EU, a little bit in the US, for passenger car segment, on the truck segment, and a lot on the off-highway tire side. So with our investments in these areas, we are very optimistic about the growth in international business. We want about 20 to 25% of our revenues to come in from international business. So we feel quite optimistic and positive on exports. With respect to EVs, I mean, it is there to stay. We are seeing a clear shift on the two-wheeler side. In the last year and a half, there has been increased demand on the passenger side. I think if you go out on the streets, you see a lot more green plates versus the whites in that sense. So that clearly shows that there is some shift that is happening. And we are very committed. We have a range which is launched on the two-wheelers, on the passenger car, and on the truck side in terms of our EV presence. And largely, I think these tires require better rolling resistance, low noise, ability to cater to heavier loads and so on. So our products are very well catered for the EV segment, and it's very, very important for us.
Years down the line, more than 20% of your total business comes from EV, whether it is export or domestic, but it could be EV. What changes for you then? I mean, will there be a change in margin? Will there be a change in realization? What changes if the EV portfolio grows?
Right. So as the EV portfolio grows, and if we're more focused or have a larger share of business, say with the OEMs at this point of time in the EV segment, that will of course reflect in the replacement segment going forward. The second change that happens is EV vehicles are much heavier. They have a higher torque, and therefore the wear and tear of tires is higher in the case of EV. That will mean a shorter life cycle and therefore hopefully longer demand of tires over time. Of course, we will use our technologies to make sure that the life of the tire continues to remain very long, but inherently with the weight of the battery being so high, the wear and tear of the tire will certainly be higher than in an ICE vehicle.
That's the other thing, actually, Anant, I wanted to talk about, because much like commodities, you would have a fair, clear picture on auto as well, right? Because there have been some changes in your product mix from FY23 to what you did in FY22. You know, for instance, the contribution of two-wheelers and three-wheelers have declined by 200 basis points. And for passenger vehicles, they've actually up 200 basis points. How do you see it panning out for FY24? And if you could throw in the EV segment as well.
Right. So this shift has been happening largely because of market situation. Our intent is to keep growing more and more on the two-wheeler and passenger car side. The two-wheeler market itself has seen a slowdown. So to that extent, that shift happened. But we want to keep gaining market share on the two-wheeler and on the passenger side. So over time, if two-wheeler plus passenger can be about 40% of our revenues, today it is somewhere around that level. So take that up maybe to about 45%. About 15 to 20% we would like to get from OHT tires, which is a high margin segment, largely catering to EU and US markets. So with all of that, if we get a strong market share position as well as a strong margin position in these categories, we'll have nearly 60 to 70% of our revenues coming from areas where we are strongly positioned in the market as well as higher margin categories. With respect to EV, I think for us on the two-wheeler side, we're there with nearly 80% of the EVs. Our market share with the OEMs will be somewhere close to about 50%. So as and when this comes into the replacement market, that will also be visible in terms of replacement demand in about 1 to 2 years' time.
Anand, just before we let you go, you clocked in a revenue growth of 20% for year FY23 and the exit rate of gross margin is around 40%. Going forward in FY24, will this 20-25% growth rate continue and gross margin between 40-45%?
Right. So with respect to the demand side, a lot of it came because of inflation and price increases. With raw material having stabilized, I don't see this inflationary impact and price increases coming into the coming year. On the demand side, I think demand is also relatively muted. I'd say we're coming out from a low base because of the COVID years in FY22, which affected FY23. That's got normalized in FY23. So FY24, I think we expect, high single digit, low double digit kind of demand growth, and not really a 20% plus growth that we've seen in the last year. With respect to margins, we expect margins to be relatively stable because we are seeing some stability in raw material prices. We don't see much pressure in terms of changes in terms of selling price at this point of time. And we're working in terms of our own cost efficiencies that will hopefully also have some positive impact on margins.
Then your large Capex, your margins are improving, which means you'll be generating a lot of cash. So what would you do? Retire debt or pay it back to shareholders?
No, currently we will be continuing to invest in Capex. So there will be about 600 to 700 crore Capex that we will be doing every year. We have a little bit of back end of the about 4,000 crore Capex that we had announced left in the coming year. We also announced about a 400 crore Capex in the off-highway tire segment. So the current year will still have some amount of Capex that we will do. And then whatever surplus is there, we will look at retiring debt at this point.
Heal, if I may use that word, for the Indian tire industry has been cheap tire manufacturing which was happening in China. That is shifting. You just mentioned that you are optimistic about exports and you are looking at building capacity outside. Where has this China 1 Plus policy affected your business, and how do you see this China Plus 1 policy will affect your business going forward?
Right. So I think largely if we look at the US and European markets, we attend some of these trade fairs, and clearly we are seeing a huge demand for tires outside of China. People want to move out. We're seeing it in the case of truck radial tires in the US, particularly off-highway tires. Anyways, we've seen some success. Now, to start selling to some of these markets, you need to make a very large investment in terms of developing a range of tires that are suitable to that market. So if you're producing tires for India, you can't just say, let me start selling those tires in the US or Europe. The nature of the vehicle, the regulations there are very different. The road conditions are very different. So it takes about a year and a half time from the day you start saying, I want to enter US to enter the US. It also requires a fair amount of Capex to get in, nearly about 150, 200 crores on top of the plant investment that you have to do. So we're in process on that. We entered Europe about 2-3 years ago. So we are in a good position out there. Hopefully the US also in about a year's time.
Well, Mr. Goenka, so nice to have you back. Thank you for joining us. And by the way, I always see this CEAT timer at IPL. Which team are you supporting this year?
Oh, I think it's for me, it's between MI and LSG.
Am I really the number 4?
I know, but I'm a Mumbaikar, so.
All right, really appreciate your time. So glad you could join us.
Great, thank you.